So today's business is a residential and light commercial HVAC business in Tennessee. Uh, Light commercial and residential, pretty common for some small sized, long term grown businesses. This is a really interesting deal. Established 1999, so it's 24, 25 years old, give or take, so very solid base. But the most interesting thing before I dive into cash flow and everything else is that this company has locked in 1,500 service agreements on the residential side and 25 on the commercial side, which is insane for a business that's only that many years in business, not run by private equity and so on. Meaning like they're doing things really well compared to other companies. I mean, at 5 million in revenue, having that many contracts is relatively exceptional. And out of thousands of HVAC deals we've looked at, in that call it $3 to $10 million in revenue range, the ones that have that much of their customer base locked up into service agreements is low, like maybe one in every 100 to 200. It's pretty solid business there. Asking price 3.5, definitely high end, almost 5 times there. But cash flow is 750, obviously probably including owner salaries and much of other stuff that may need to be replaced, but not too bad. The EBITDA margin here is not bad when you compare it to gross, or the cash flow margin is not bad when you compare it to the revenue saying 5 million. Obviously these are rounded numbers, so they haven't released full proper financials, but 62 grand a month, not bad. And the owner is willing to finance some, so even on a small down payment, um, the business works. The business works. Let's put it that way. But cash flow versus debt service, when you look at current asking and everything else, even with everything all in, you are looking at a relatively borderline level of cash flow versus debt service. It's only just above the SBA requirement for debt service ratio. So that said, overall good business, but there's definitely some things to be adjusted here to make it work for a very solid level. But I'll go into that in just a second. Main considerations, basically, number one, super strong customer base. If you have 1,500 service agreements on residential, 25 on commercial, that's a lot of cash flow that's recurring. And if you really wanted to, you could potentially just buy this, shut down the install division, and just have a crazy amount of cash flow continuously coming in. Number two, it's 26 people, which is kind of heavy for the size of revenue, which kind of points towards, for me, that they've overstaffed enough to not have a lot of owner involvement based on what I've seen in the HVAC space. And they are pretty clear with it, and having, they have their service techs, they have their dispatcher, they have their install manager, but they have a metal shop and warehouse person, which is kind of rare for this size, or like, it's more between the 5 and 10 million in revenue range that you see this. Having a full-time bookkeeper as well, even at this size, is kind of excess. So there's a good amount of kind of overstaff here to a certain extent. And then Comfort Advisor is just the salesperson, but only having one for 5 million means they really, really rely on their service division as their core revenue. So it'd be really interesting to see the breakdown of this in terms of whether it's really that skewed in terms of service revenue. Which, if it is, I mean, perfect. That means there's also a lot of growth potential here, assuming that you can keep up with the HVAC installer recruiting. And so the third thing to kind of consider here is it is 60-40 mix, which is a little bit heavy weighted on the commercial. Now, it does depend what the service agreements are, and they have specified it's more of these apartments and things like that. They're usually pretty continuous. The warehouses, offices, and retail outlets are more the ones that are not great. Like, those are the ones where when you hit a recession, they're the first ones to drop service agreements and try and lean things out as much as possible. But assisted living apartment complexes, those are ones where they just they keep that they keep those agreements on. So it depends how you'd want to further adjust that. But if you can get in, do a bunch more installs, lock in some more residential service agreements, weight it more towards an 80-20, 80% residential, 20% commercial, you can do some pretty good mix there. But yeah, I mean, that said, good business. They don't do like a ton of change out, which is really interesting. So there's a lot of room for growth. and the seller is willing to do some financing, which is always good. That means you can make it work, full SBA, full seller finance, and make that work. Owner is willing to assist for 3 months. Also means they are reasonable here, which is good. That obviously should get shot up a good bit, probably 6 to 12 months, with the option to kick them out after. But when you look at it, if you look at this as a straight SBA on 3.5, this is more what I mean. So effectively $442,000 in annual payments on a 25% seller finance, which, pretty reasonable, I'd say, to ask for 75%. If you're giving 75% in cash, ask for 25% seller finance delayed. But the real scenario would really be get this to about 3 million, about 4 times EBITDA. That's more in range, especially given the HVAC and plumbing market was previously super high in trade value, whereas now it's not seeing that same trade value. It's gone down a lot. Where we used to see companies like this selling for 8 times, now they're 3 to 4 times again, because the bubble has burst there. Private equity is not buying as heavily in the US as they are in other countries now. So what that would look like on something that you kind of readjust, 3 million, 3 million total price, 25% seller finance note, which you could push if you really wanted to, 379,000 in annual payments. That makes it very close to a 2 times debt service. And that becomes a good deal. That becomes a deal you definitely want to jump on and execute on very quickly. So overall, not bad, very solid business. It'd definitely be worth looking into. And this is likely one that we're going to be pursuing with a partner here because it's a good deal. It's definitely a good deal.